Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. This is an extra episode. There is so much from this week we need to cover that we have this episode today, so we're ready for a new week of updates from tomorrow. Let's jump in. As US President Donald Trump departed for Italy to attend the funeral of Pope Francis, the news back home for his administration was bleak. Signs of economic distress amounting, with US consumer sentiment plunging to historic lows and corporate America sounding the alarm about the escalating costs of the administration's tariff-driven trade war. The only silver lining for the US is that, even though things are not looking too good, it's much worse everywhere else. The final University of Michigan Consumer Sentiment Index for April fell to 52.2 from 57 a month earlier, marking one of the lowest readings since the survey began in the late 1970s. Meanwhile, long-term inflation expectations climbed to 4.4%, the highest level since 1991, and year-ahead inflation expectations reached 6.5%, still dangerously elevated despite a slight pullback from preliminary figures. The survey period, spanning March 25th through April 21st, coincided with President Trump's announcement of 90-day pauses on higher tariffs for some U.S. trading partners, a move that brought little relief. Tariffs on Chinese goods were simultaneously raised to a staggering 145%, further fueling fears of higher prices and weaker economic growth. Quote, "Labor market expectations remained bleak," end quote, said Joanne Tsul, director of the survey, adding, quote, "Consumers anticipated weaker income growth for themselves in the year ahead. Without reliably strong incomes, spending is unlikely to remain strong amid the numerous warning signs perceived by consumers," end quote. Indeed, about two-thirds of the respondents expect their inflation-adjusted incomes to decline over the next year, and nearly as many foresee a rise in unemployment. The decline in consumer sentiment was broad-based, affecting every demographic, income, and political group. Expectations among Democrats and independents fell to record lows, while Republican sentiment also sagged to a 5-month low. On the corporate front, alarm bells were ringing louder. Tariffs have been cited in more than 90% of first-quarter earnings calls so far, with the word recession appearing in 44% of them, a stark rise from the less than 3% in the fourth quarter of 2024. Companies are warning that tariffs and economic uncertainty are trimming profit forecasts. P&G estimated that current and proposed levies could add between $1 and $1.5 billion to its annual costs, a burden the company plans to offset through price hikes. Quote, "Tariffs are inherently inflationary," end quote, P&G chief executive John Mueller told CNBC, underscoring a sentiment increasingly echoed across boardrooms. The impact of Trump's trade war is reshaping corporate strategies in profound ways. Apple, for instance, is accelerating plans to shift the assembly of all US-sold iPhones to India by next year, doubling its output there to mitigate risks from Chinese tariffs. We will cover this again shortly. Other companies like Amazon and Walmart have begun hoarding stock in Canada, attempting to buffer themselves against the disruptions. The fallout isn't limited to consumer goods. Defense contractors are reporting higher input costs, medical device makers blame supply chain disruptions for higher hospital prices, and US bicycle prices are projected to rise by as much as 50%. Even traditional Trump-aligned sectors are feeling the pinch. In North Dakota, oil producers are expressing frustration as tariffs ripple through their operations. Still, not all reactions are negative. Some businesses see opportunity in Trump's trade posture. A handful of pharmaceutical companies are boosting US investments to sidestep sector-specific tariffs. One company announced a $50 billion investment in American manufacturing and R&D, while Novartis pledged $23 billion. In other industries, including automaking, intense lobbying appears to have spared some companies from the harshest tariffs. With recession risks mounting and inflation expectations soaring, President Trump's departure for Italy leaves behind a country grappling with rising economic anxiety and an increasingly uncertain future. Next up, like I just said, Apple is preparing to shift the assembly of all iPhones sold in the United States to India as early as next year. The move marks a dramatic acceleration of Apple's supply chain diversification strategy in response to escalating trade tensions under Donald Trump's administration. The technology giant aims to assemble the entirety of its more than 60 million iPhones sold annually in the US from India by the end of 2026. Achieving this target would require doubling India's current iPhone output, a major shift after nearly 2 decades of heavy investment in building China's manufacturing ecosystem. China remains Apple's primary manufacturing hub, with partners like Foxconn overseeing the bulk of iPhone assembly. However, US tariffs targeting Chinese imports, initially exceeding 100% before temporary reprisals were granted, have pressured Apple to rethink its dependence on China. Although smartphones briefly escaped the higher levies, they are still subject to a 20% tariff, adding to the urgency for the shift. In response, Apple has been steadily ramping up its Indian operations through partnerships with Tata Electronics and Foxconn. While final assembly is the last step in the production process, Apple continues to rely heavily on Chinese suppliers for many components. To facilitate India's expansion, Foxconn and Tata have begun importing pre-assembled parts from China. The US market accounted for approximately 28% of Apple's 232.1 million global iPhone shipments in 2024, according to the International Data Corporation. To meet demand, Apple will need significant capacity growth in India, where efforts are already underway. India's position is further bolstered by ongoing trade discussions with the United States. Although India was initially hit with a 26% reciprocal tariff, enforcement is paused as New Delhi pursues a broader trade agreement. US Vice President J.D. Vance, visiting India this week, stated that negotiations are making, quote, very good progress. End quote. Apple's strategic pivot comes amid significant market pressures. After Trump's tariff announcements, which wiped $700 billion from Apple's market value, the company quickened shipments of India-made iPhones to the US to mitigate tariff imports. Industry analysts view the move as essential for Apple's future. Quote, we believe this is going to be an important move for Apple to be able to maintain its growth and momentum, end quote, said Daniel Newman, CEO of Futurum Group, adding, quote, we are seeing in real time how a company with these resources is moving at relative light speed to address the tariff risk, end quote. Apple is set to report quarterly earnings next week. While the company has refrained from offering precise guidance or commenting directly on tariffs, CEO Tim Cook has maintained close ties with the Trump administration, underscoring the stakes of Apple's shifting strategy. Next up, we have one more development to cover, but just quickly a piece of housekeeping. Next week, I am taking a vacation. It's been 6 weeks of Market Update, my second of 2 channels, and it has been a very busy time to launch a new channel on global markets. With the global trade reset, it has been 12 to 14-hour days. So I'm taking a break next week to allow myself to reset myself and to recover and prepare for what will be an incredibly busy year ahead. Now, the channel will continue next week. It's just the frequency of episodes will be reduced by 50%. Next week, China Update, my other channel, will have 3 episodes per week as opposed to the regular 6, and Market Update will also only have 3 videos. So next week, there will only be 3 videos of Market Update rather than daily episodes. After next week, the schedule will return to normal. Thank you for your understanding, and if there is an emergency episode that has to happen, then this will happen as well. Like I said, it's going to be a very busy year ahead. The world is going through tremendous change. If you want to be on top of the most up-to-date analysis and developments on this changing world as we move through it, consider subscribing to Market Update. If you're getting some value from today's episode, don't forget to hit the like button. Let's continue. The European Central Bank is nearing its long-term goal of restoring inflation to 2%, with fresh data from this week suggesting that consumer price growth across the euro area is stabilizing. According to a US-based Bloomberg survey of 32 economists, inflation likely slowed to 2.1% in April, just a fraction above the European Central Bank's target. Meanwhile, core inflation, which strips out volatile elements like energy, is forecast to rise slightly to 2.5%. The central bank president struck an optimistic tone on Friday, reiterating that, quote, the disinflation process is well on track, end quote, and that inflation should, quote, hover around our 2% target, end quote, going forward. The French central bank chief was even more confident, stating that, quote, there is currently no inflationary risk in Europe, end quote. France's inflation is expected to slow to just 0.7% this month, though readings in Germany and Italy are projected to remain above 2%. Economists at Bloomberg predict that euro area inflation could dip below 2% during the summer. helped by lower energy costs and easing pressure on services prices. Weak economic growth and disinflation in goods prices are expected to give the European Central Bank room to continue cutting rates. Meanwhile, early GDP estimates show that Europe's largest economies posted modest growth in the first quarter of 2025. France grew at 0.1%, while Germany, Italy, and the wider Eurozone each expanded by 0.2%. However, these figures do not yet reflect the potential impact of US President Trump's recently announced tariffs, which are expected to weigh on future growth. Quote, business surveys for April suggest that US tariffs have not done much damage so far, end quote, said Andrew Kenningham, chief Europe economist at Capital Economics, adding, quote, but we think there will be a noticeable impact in the coming months, end quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Sunday, have a restful weekend, and I will see you for a new week of updates tomorrow.